Thank you, Mr. Ikeda, Chief Sustainable Finance Officer at the Japan Financial Services Agency. Welcome to this opening panel focusing on the regulatory agenda, expectations and greenwashing. I'm your host, Nick Wakefield, co-founder of Regulation Asia and sister publication, ESG Investor. Now, you could break the ESG requirements into two distinct areas. The data that regulators want from financial institutions, that is about their products, processes and strategies, and the data that regulators, exchanges, and investors want and need from their corporates to inform their own policies and manage risks, with a key objective for both areas being to avoid greenwashing. The important element here is the data, and we need rules on what companies are supposed to report. These were voluntary, they're now becoming regulatory. In this session, we will discuss these issues and in particular hone in on the developments across APAC in regards to the adoption of rules about climate and ESG reporting. To tackle this conversation, I'm delighted to introduce my fellow panelists. Mary Leung is Head of Advocacy, Asia Pacific at the CFA. Welcome, Mary. Matthew Chan is Head of Public Policy and Sustainable Finance at ASIFMA. Welcome, Matthew.
Thank you.
And Jason Lee is Managing Director, Legal and Regulations at Temasek. Welcome, Jason.
Good afternoon.
Afternoon. To kick things off, I'd like to perhaps discuss how we've got to where we are today. Mary, at the CFA Institute, your role is to track policy and provide policy recommendations. Perhaps you can walk us through some of the developments in ESG regulations that we're seeing globally. Sorry, Mary, I think your sound is a bit low.
Is this better?
A little bit. It's still very low. Sorry about this.
Hi, Nick. Can you hear me now?
It's a little bit better, but yeah, it needs to be a bit louder.
Okay, I will.
Yes, perfect. That's great.
So for those of you who may not be familiar with the CFA Institute, we are a global association of investment professionals, and our members are mostly investment institutional investors, portfolio managers, and analysts. And the perspective I would like to bring today would be that of investors. So when we talk about ESG regulations or ESG standards, I can almost hear a collective groan, and because there's so many, right? So I want to show a chart which attempts to capture some of these regulations and voluntary standards. So this chart shows investors at one end and companies at the other, and investment managers kind of sit in the middle to facilitate and direct capital flow from investors to companies. So when we talk about ESG regulations, loosely, I think the chances are that we're probably talking about issuer reporting, which is on the top left-hand corner. So you have your TCFD, which is climate focused. SASB is another one. It focuses on material ESG issues for different industries. There's GRI, and there's also in Europe the non-financial reporting directive, and all of these deal with issuer disclosures. There are also others. If you come down to the kind of the bottom left-hand corner, there are others that deal with green, social, and sustainability bonds issued by companies, and these could be, you may have come across green bond principles or the social bond principles issued by ICMA, or the climate bond standards issued by the Climate Bonds Initiative. And these are all voluntary standards that have contributed greatly to the mainstreaming of green and sustainable finance. Moving on to the middle of the chart, we have investment managers. They are increasingly being asked to improve their disclosures, both on their approach and processes in managing climate or ESG risks, and on reporting outcomes in relating to their stewardship activities. In the past, they were very much consumers of climate and ESG disclosures. I think increasingly they are now also preparers. And overlaying all of this, as we've heard from both of the keynotes earlier, there are taxonomies which provide the language and the framework that allows sustainable activities to be recognized and defined. There's another overlay, of course, which are the regional and national regulations and legislations. The most eye-catching is probably the ones in the EU. They have the taxonomy regulation. They've also got the NFRD, which we just mentioned. They mandate public annual ESG disclosures by companies. There's a proposal to upgrade the NFRD to CSRD, Corporate Sustainability Reporting Directive. which will cover more companies. There's also in the EU the Sustainable Financial Disclosure Regulations, the SFRD, SFDR, which requires disclosures by asset managers at both the entity level and at the product level. So that's probably the most relevant and most impactful on the asset management industry. And if you think about it, they are all interlinked, right? If we consider the information flow along the investment value chain, you need to have the framework, the taxonomy to define what activities are sustainable. And then you have the reporting rules, which will allow company to report how much revenue and assets and capex that they have that's taxonomy aligned and that are sustainable. And then investment managers can integrate the issuer information into the decision-making process, create products, and in turn make their own disclosures. So just a few quick observations before I leave this slide. So I know there's a lot of confusion because there are quite a few standards out there, particularly in relation to issuer disclosure standards. And I believe that's being addressed. And I think the announcement and the establishment of the International Sustainability Standards Board is a great way forward because they're going to consolidate the Value Reporting Foundation, which houses the SASB and the IRRC, as well as, and then the consolidation of that with CDSB. So that's most welcome. And as issuer disclosures become more mature and they improve, there will be more attention on investment manager disclosures, both at the entity level and at the product level. And at the product level, CFA Institute has also just released the ESG disclosure standards for investment products, which are the only global and voluntary standards that are out there that are designed to accommodate the full range of investment vehicles, asset classes, and ESG approaches. Now, what I think is going to be a feature going forward is that this is an area that will continue to see partnership between governments, regulators, and the private sector. And I think it's important that we have the best solutions from both the policy perspective as well as the industry perspective. And I'll stop there. Thank you.
Thank you, Mary. Let's go into some of the specifics across Asia Pacific. And we've seen a flurry of activity in the region, as Mary's kind of mentioned, with regards to regulators coming out with their intentions, along with regional and local working groups. Jason, you work for one of the region's largest asset owners. Perhaps you can give some perspective on what you're seeing across Asia and what developments firms like yours are mindful of.
Great. Thanks, Nick. Just a couple of things, and I'll just start off by stating the obvious. APAC itself is multi-jurisdictional, it's fragmented. So it's unlike the EU where you have a common supranational regulator, or even the US where you can at the federal level legislate and provide for something. So again, we start off at the basis that it's multi-jurisdictional, so it's a fragmented regulatory environment. And overlaid of that is the even global taxonomies, standards, and practices are not universally adopted, and they are sometimes adjusted locally. So that just sets the frame of how messy APAC is. Now, I'll move on to the second point, and just again, it's a fairly large space, Nick. So there'll be some folks here who might feel that I've left out some of the new regulations coming up, and there's really, in my mind, these are the things that we should think about, and they're things which have come up in the last couple of weeks, with the exception of one thing, which I'll just and I'll go through that. So I'll just do a quick whistle stop tour of the key areas. Broadly, four parts. One is disclosures. The first is in the last couple of weeks, we've seen the SFC come out with disclosures for managers of collective investment schemes in terms of incorporating risk management and disclosure standards in relation to climate-related risks, right? So they came out with that. They have amended the code for fund managers and also set out the expectations on how people are supposed to adhere to it. So there were actually basically four components of that. It deals with governance processes, investment management processes, disclosures, and also risk management. So all those things are something which the investment managers need to think about. The second one, I just will highlight what Mary said on ISB, which is the setting up a common disclosure standard for sustainability and climate risk. People sometimes underestimate the significance of that. But I think it's a brilliant idea, latching on to the IFRS, which is accounting standards. So you immediately get the backbone of framework to reach out to 140 different jurisdictions. So that's a significant play. So that's on the disclosure side. On the green finance side, there's been a flurry of sustainable linked financing the standards, but one I would like to call out is the ASEAN Taxonomy Board. They released the ASEAN Taxonomy for Sustainable Finance a couple of weeks ago, and it serves as a reference point to guide capital and funding towards activities that will serve to help and facilitate transition to a low carbon future and sustainable financing in ASEAN. So that's on the green finance space. The carbon trading is also picked up in the last year, with the big call out is in China. So that's one which was launched in July. That framework itself, there was within the market something which was expected for the last couple of years, and they finally launched it. Now, if you look at it, some of the key features, right? It covers single sector, which is power generation, but then you think about it again. Power generation is a big thing in China itself. And if you look at it, it covers 40% of the carbon emissions in China, which and by itself covers 20% of the global CO2 carbon emissions, right? So it's a huge market which has been launched. I think over a period of time there could be some adjustments to it, increasing the sectoral coverage, allowing foreign participants, and actually setting broad caps on the market. So that's a space which is significant in the carbon trading. Lastly, and it's not to do with regulations, but actually has to do with impact on how people conduct themselves. I want to talk about climate litigation. So what we've seen generally, climate litigation can fall broadly into three buckets. Firstly is the action by shareholders or product buyers on greenwashing. Secondly, it's also action against companies for damage to the environment. And the third category is the public sort of litigation. We've seen it where people sue their governments and so on for not taking into account climate risk. Two actions, and a lot of these litigation actions in APAC, at least centered in Australia, but I think there's been significant developments there. Over the last couple of weeks, there have been two cases I want to call out. The first is Abrams against CBA, where the court ordered CBA to give the plaintiffs authorization to look at the bank's internal documentation on oil and gas projects, and to use that as a benchmark against some claims which the bank has made. So that's a significant case. And also recently, the Court of Appeal in New South Wales themselves upheld a decision to refuse a coal mine from being operated based on the negative climate impact from the fossil fuels that would be extracted. So that's again an area to watch in climate litigation. So with that, I'm just going to call an end to my whistle stop tour, Nick. But again, as I said, this is just to give a flavor of the key things which I think are pertinent in the last year.
Excellent. Thank you very much, Jason. Very comprehensive view of kind of the APAC region. Matthew, I want to come on to the subject of greenwashing. This is an off-banded kind of about term. How do you see regulators kind of treating that across APAC?
Thanks, Nick. And yeah, so obviously I'm speaking on behalf of ASIFMA. I mean, we've been looking at sustainable finance for some time. We have both across our membership, we've got the buy side and the sell side, as well as many of the market participants involved in sustainable finance. So it's great to have hopefully a fairly broad view of these things. You're right in terms of greenwashing being bandied around quite substantially. And I think it's a theme that probably cuts across a lot of what Mary and Jason have already spoken about. In some ways, it's a lens through which we can look at the issues and the developments that have been taking place. I suppose also you can look at it in a historical perspective. So a lot of ESG, of course, started with CSDR, corporate responsibility, etc. And so as we've moved from a much more kind of narrative-based, sometimes a little bit of marketing in the corporate space, to much more kind of science-based metrics, quantitative metrics, this issue of greenwashing has kind of come to the fore because there has been a risk at times for there to be things that have been kind of described as green, but actually when you kind of scratch the surface, it's either not substantive or indeed sometimes things that have been a little bit misleading in the past. So where are things happening from a regulatory point of view? And I think Mary's diagram was great in that, and also I think Jason mentioned it too, is kind of that division between the corporate sector versus the asset managers in the industry. So from a disclosure point of view, from the corporate perspective, I kind of see it, and of course the voice of our buy-side members is that from an investment management perspective, as they've looked and interrogated ESG data requirements on behalf of their investors and started to look at those kinds of issues from an investment point of view, they have been asking for improvements in terms of disclosure, making sure that there's accurate information, that is comparable, it's decision useful, which is of course a term that everyone is using now, but also that it's trustworthy and auditable. And then of course that's flowed into kind of the requirements of the various stock exchanges, and we've seen of course the Hong Kong Stock Exchange. I'm in Hong Kong. We've seen them raise their standards in terms of ESG. Then, of course, within the asset management and fund management sphere, we've also seen a rise in terms of focus amongst regulators, particularly in terms of making sure that from a product labeling perspective, so the disclosure by asset managers is trustworthy, etc., that there's quality, that there's consistency, that there's comparability. I mean, that really started in some ways with the EU, with the SFDR. So this was about trying to make sure that the disclosures were able to be trusted and that they were scientifically based, etc. And then, of course, we're seeing within jurisdictions across Asia Pacific, we're seeing similar kinds of focus. We had Tim Loy before from the SFC, chair of the SFC. The SFC, of course, earlier this year had published their requirements in terms of both what disclosure they would like to see from a fund's perspective, but also how are they incorporating ESG factors. And then, of course, another development that we're seeing is kind of policymakers and stock exchanges coming together to say, well, actually, perhaps we can provide repositories of data. And so we're seeing things with Stage, with the Hong Kong Exchange. We're seeing, the idea of bringing together a platform that indeed might house data that can be used, so that one, you're starting to ensure that you've got standards, because of course to get onto the platform you need to have certain standards, and then comparability. And we're also seeing similar developments in Singapore with Project Greenpoint. I should also add that we've of course covered corporates and some of the scrutiny on elimination of greenwashing there. We've kind of looking at we've seen securities regulators starting to look at the issue from a kind of product labeling perspective. But then, of course, the banks themselves are also facing a lot of requirements in terms of the disclosure of their environmental risk information. And so that's another area where there's a tightening up. And of course, we've mentioned other global developments. Of course, the International Sustainability Standards Board, which I think is a kind of tightening up, at least in terms of the standards. Of course, it remains to be seen how they will be rolled out into the different jurisdictions. We've also seen IOSCO, which is the International Organization of Securities Commissions, its focus on data and data providers. So again, that's another focus in terms of driving up that reliability of data, third-party data provided to the market. And then my final point, of course, is carbon markets, which I know Jason touched on. I mean, I think there is a need to tighten up some of the standards in carbon markets. And of course, we've got compliance markets, so emissions trading schemes, but also we've got the voluntary carbon market sector. And so there's a little bit of work to do in terms of bringing up the robustness of the, particularly of the offset market, etc. Because again, there's a concern around greenwashing.
Thank you, Matthew. Mary, you spend a lot of time speaking to investors, and what's their perspective on this, and what information are they asking for, and what would they like to see?
Thank you, Nick. I think just to step back, investors would like to see timely, relevant, consistent, and quality information. I think everything that Matthew and Jason have been saying. And I think importantly, they need that information to allow them to assess how companies are treating some of these material ESG issues, and how they are going to impact on the value of the companies that they're investing in. And in many of the surveys that CFA Institute has done over the years, the lack of a common set of international standards or having a lack of consistent metrics have been cited as a major barrier for investors. So if you think about it, investors are investing and deploying capital across borders. So it is important to have a single common high quality language that will allow them to evaluate opportunities on an equal footing. And I think having that will be valuable for both companies and investors. But to address your question, I think investors are increasingly looking not just at risk and return, but risk, return, and carbon. So this is an additional dimension. I think the conversation around what data is needed is still evolving, but I think there's also a broad consensus on things like greenhouse gas emissions and carbon intensity. But I think Ikeda-san from the Japan FSA just now made a really good point, and that's to be able to come up with a robust enterprise value. You will need forward-looking targets or forward-looking projections, and therefore, when we're talking about carbon emissions or greenhouse emissions or carbon intensity, we're not looking at static data. We're also looking at some sort of comfort around the projections that companies are making, the trajectory where they are here, where they are today versus where they're going to be, 3-5 years down the line.
Thank you, Mary. Now, a word that's often used across regulation, particularly in APAC, is fragmentation. Do we think we're likely to see the same with taxonomies across the region and other areas of ESG reporting and coordination? Matthew, perhaps you could talk a little bit to this.
Yeah, sure. I mean, fragmentation is something that we've been looking, particularly market fragmentation driven by regulation, is something that we've been looking at for some time at ASIFMA. And in fact, when we did our report on fragmentation to IOSCO and the Asia Pacific Regional Committee, it had a section back in the beginning of 2020 on fragmentation. So in the beginning, a lot of people were not talking about or seeing the vulnerability of sustainable finance and ESG, the ESG market in relation to the risk of fragmentation. But indeed, it's probably one of the best case studies of fragmentation, because if you think about, for example, transition finance and climate finance, when we did our research at the beginning of the year, we found that we needed 100 to 150 trillion US dollars reallocated to transition. And that's just accounting for the top 10 sectors and what needs to happen for us to meet Paris. So you need a whole lot of capital to move across markets, across borders to hit those projects to enable transition to lower carbon intensity. You can't do that if you have market fragmentation. You can't have efficient markets, whether they are allocating capital to transition projects, if you have fragmentation. And taxonomy is one area where we've been very focused in terms of making sure that there's a real focus in terms of making sure that we see coordination. So we recently released a report of guiding principles. It wasn't a taxonomy, but some guiding principles for regulators to think about around the world. That was released in June, and we covered off a few different principles, but basically it was to say that we actually need to think more broadly about beyond green bonds. We need to think about beyond use of proceeds structures for taxonomies to be applied because of the scale of investment needed. They need to be objective, so taxonomies need to be based on very clear metrics. There needs to be consistent principles and definitions, and so we're not saying that every market needs to have the same taxonomy. Indeed, while we would like that from an industry point of view, we know that that's a little bit of a nirvana, but we do see the benefit in seeing consistency between principles and definitions, and of course governance structures. And governance structures to make sure that when taxonomies are developed and improved, that there's some kind of robustness to the process by which that happens. We were also very careful to make sure that people are aware that one taxonomy may not be suitable for another. And so one of the examples, of course, is the EU taxonomy. The EU, we need to doff our hats to the EU in terms of the leadership that they've provided in terms of climate finance and focus on ESG. But at the same time, a taxonomy that's been developed for the EU may not necessarily be well or forgiving for a region such as Asia, where you have a mix of developed countries, but as in addition to that, emerging markets. And of course, the idea of transition is really important It's very hard to classify everything into green and brown when in fact there might be shades of green or in fact shades of brown, but actually it's important to be able to recognize improvements along that transition path. So that's really something that's really important. So and obviously there's been a lot of work. There's I mean, if anyone wants to have a look, I think the Future of Sustainable Data Alliance that I think Akita-san mentioned has a work stream on mapping data to taxonomies, and within that work stream they've mapped out all the different taxonomies. There's countless numbers. In our own region, Malaysia, of course, drafted one earlier. We've had the Singapore GFIT one. We've had the ASEAN Taxonomy Board produce theirs. One of the most recent ones, surprisingly, is Russia, and by all accounts, that's actually quite a useful one to look at in terms of they're starting to learn from some of the not mistakes, but some of the areas of improvement for other taxonomies, but also some of the advocacy that the industry is providing in terms of how do we make these things all happen. The final point, of course, I'll make on taxonomies is, as I mentioned earlier, we can't expect to see one taxonomy across the globe. What we are working on at the moment is thinking about how do we encourage interoperability? How do we think about, and of course the International Platform for Sustainable Finance has a consultation out at the moment to look at the work that it did in comparing the EU versus the China taxonomy. A very useful exercise in terms of understanding that big gap that exists between just two taxonomies. But going forward from a practical perspective, the industry really needs to see concrete measures in terms of how do we deal with these differences. And so something that we're looking at is kind of the principles for recognizing maybe mutual recognition of taxonomy. So if you're a European investor, you might be investing in a Canadian company, but with projects in Asia. Which taxonomy do you apply? And so it's really thinking about, how would that happen from a mechanistic point of view, but also you don't want greenwashing. We talked about that. How do you do that in a robust way so that you recognize that, yes, actually it's okay to use this taxonomy because they're able to be, this one's able to be recognized, but it's also applicable to this particular company.
Excellent. Thank you, Matthew. So let's dive into one of those points you made there about the mechanics of it all. In terms of the actual data and technology, Jason, what are some of the challenges that you see facing large asset managers and companies in adhering to kind of the various standards?
So I think one thing which has actually not been considered in detail, like, is the whole stress that is placed on the operations of the asset managers, right? So it goes into data, but I'll just give a bit of background. So what many of the asset managers themselves, when they receive funds from clients, it's not being mandated. So a lot of it is actually private client mandates, right? It's not regulatory requirements, which means there's very bespoke sort of investment mandates relating to ESG, which the entity has to execute, right? So that itself, now how does that translate into the day-to-day operations? One, it puts a limit on the amount of scale that you can deploy. Two, it makes the front office face more challenges in terms of how they construct portfolios and investment decisions they make. And in the middle office, it also provides more stress on how the compliance functions or the risk functions monitor adherence to these mandates, right? And overlay on top of that is also the adherence to the different regulations. So you have a very complicated situation where the requirements on which you have to base your actions is complicated, is complex, and it's not scalable, right? So that's the base case. Now you overlay that with the concept of data coming in, right? Data, there's a couple of things here which when you interact with the complexity makes things more difficult. Now, if you look at the IOSCO report, which just came out, I think last week or a couple of days ago, on ESG ratings and data providers, right? They identified various issues and they made 10 recommendations, right? And those recommendations revolve around a couple of things. One, the reliability of raw data. Secondly, the transparency of the ratings methodology and data products. Three, the reliability of those products itself and ratings, and that goes into things like, how you manage conflicts of interest, what sort of robustness you have in quality control, and so on. Fourth, the level of engagement you have with the companies and entities which you regulate. So if you look at these things, right? So I'm just trying to pull these things together. You have a complex environment which asset managers need to operate, right? The complexity is derived from the multitude and fragmented approach of the regulations and also your different client mandates. That's one. Overlay on that, you actually need data because it's very hip to say everything revolves around data, but actually in ESG space it actually does, right? In the word someone has described to me as data in ESG is like words in a book, right? If you don't have the words, you don't have a book. So that's how you deploy. So how do the asset managers face these challenges in using the data with all these issues and problems that we find to deliver a product and adhere to their mandate? So that's actually pretty challenging, Nick, and I don't think it's going to get easier or any period of time until the market itself finds some sort of equilibrium, and this equilibrium itself could come out from different things, of voluntary standards, adherence to the IO scope proposals, and so on. But that's going to be focused. It's going to be a big of a challenge.
Yeah, definitely. And what, just very briefly, what do you think are those kind of the stakeholder expectations from asset managers and investee companies?
Well, I think there's going to be a couple of things with regard to the ESG. One, it's you start off again, it's data, right? You have your proper data, disclosures, and so on, reliability, robustness of your disclosures, and how you actually execute that. So that's key. Disclosures and data, that's something which we want. That leads to the second point, actually the adherence to the mandates and what we ask you to do. Do you say what it's on the tin and you execute according to your mandate which we have given? That's key expectation. Now, beyond that, there's actually a bit more. Firstly, we also need you to understand whether you actually incorporate ESG in your investment decision-making processes. We go back to what the SFC has said, right? How do you incorporate that into your investment decisions, your risk management, and so on? It's a good example. Asset managers have their fiduciary duty. Fiduciary duty involves looking after the risk and incorporating the risk in making decisions, right? An investment manager who doesn't view climate risk in its investment decisions, doesn't incorporate that, it's not actually discharging its fiduciary duty. So that's another expectation that we have. And the third expectation, I think for many industries, that they'd actually like to see the asset managers collaborate and work together to influence policy and to try and build the common standards, right? So it's pretty, shouting at windmills kind of work if we just have one asset manager trying to change the world. So I think that's also, we see as a place for these asset managers also to work together, to collaborate with the different stakeholders. So, that's the things I would say: proper disclosure and data, adherence to your mandate, incorporating ESG into your investment decision, risk management purposes, and also taking thought leadership seriously and collaborating with your fellow asset managers and trying to shift.
Yeah, absolutely. Collaboration, the key here. So Mary, what are you hearing from the market in relation to the data challenges on your side from the financial institutions?
Sure. I think data always gets a bit bad reputation, right? But I think the most savvy operators that we're talking to have been telling us that they are increasingly using alternative data as a means to bridge the gap that they have between issuer disclosures and what they want to get to. And through the conversations that we've had, three things stand out. The first is that alternative data will make sustainability analysis more robust, and that sustainability is an area that human judgment and active management will thrive. And lastly, AI will be making a significant contribution in the area of sustainability data collection. And I think this is actually more of an opportunity rather than a hindrance, if you catch my drift. Because sustainability data is often contextual, right? Subjective. And while technology plays a key role in amassing that data, it still needs to be cleaned and structured and filtered and turned into something that's decision useful. And that is where the human layer comes into it. You need the human judgment to determine materiality, to turn it into something that's decision useful. So the ability to harness this data into the investment process is key. And by combining real-time alternative data and backward-looking data from issuers and rating agencies, our members are telling us they are confident that they can build a more complete picture and make their analysis more robust.
Thank you, Mary. Matthew, I just want to quickly turn to a paper that ASIFMA released last year, I think around December time or something, just around the data challenges and opportunities across sustainable finance. It's been roughly a year since then. What's been the progress and kind of what feedback have you seen from the market with regard to that and what's been going on?
Yeah, no, thanks, Nick. We did do that report. It was the end of last year, and it was very, very much a paper that tried to look at all the different issues, and I won't go through them all, but obviously things like comparability, a lack of comparability, the lack of availability, the kind of issues that Mary just talked about in terms of unstructured data, but also some of the opportunities and also some of the recommendations. I think the big differences or the changes that we've seen, I think, is one that we're talking about it. So back then, people weren't talking about data issues, not so prominently amongst the regulators, not so prominently in conversations like this. And so I think that's one of the first things to recognise. We've seen, of course, in the official sector, we've seen, for example, in Hong Kong, the cross-agency steering group. So that's a group of officials working with the industry to look at Hong Kong as a green and sustainable hub. What are the two working groups that it has most prominently? One on data and one on capability and training to create Hong Kong in that way. And then, of course, we're seeing the ongoing evolution of the Future of Sustainable Data Alliance. And so this is a private sector initiative. ASIFMA has been part of that since then, and in fact, wrote the report as one of the work streams for that. And that's really continued to move ahead. So looking at the challenges around data, specifically for ESG. So looking at the data gaps and holes, which Akita-san mentioned, looking at forward-looking data. So thinking about, well, what data do we need forward-looking? So that's very relevant for kind of climate risk management, thinking about this kind of taxonomy versus data. So, but most importantly, it's actually tying together what do we need in terms of talent development and capacity building, not only for ESG, but in fact, looking at ESG data. And so I think Mary and Jason have touched upon this. We need to use data in a different way. And Mary talked about the fact that we can't just solely rely on AI. While AI will be potentially critical, we need to have people that can make decisions about what data do I use, how do we store it, how do we cleanse the data, how do we filter the data, how do we use the data, how do we report the data. And so it's this kind of integration of understanding of the data, understanding of the science, but then also understanding how to fit that into business processes. And of course, one of the recommendations of the report was that regulators need to look at third-party data. And of course, we've just seen in the last few days, IOSCO talking about the need for securities regulators to think about data providers, rating agencies, and so on. So we have seen some developments since the paper.
I want to kind of thank you, Matthew. I just want to kind of think about now kind of moving forward and what's next. If we take a step back from the data and just look at the markets in general and what's going on. Sticking with you, Matthew, what do you think, or what can you see as being some of the big developments, I guess, if we look out kind of over the next 5 years or so?
So I kind of look at this in terms of building blocks. And obviously the big challenge at the moment is climate. That's, we've just come out of COP26, but that's important because it's one of the most urgent challenges. And I kind of see the building blocks are getting everything right around taxonomy. So we touched upon that. What are the coordination structures that need to happen? How do we get interoperability? We've talked about disclosure. So a lot of the regulators are thinking about disclosure, both at the corporate level and then also at the fund management level. Data is a third kind of building block. So a lot happening there. And we don't need to go back into that. But obviously, we need to get those building blocks right. How do we have coordination across all those kinds of issues? So if we're thinking about a region like Asia Pacific, we do need coordination to minimize fragmentation. We're starting to see that through IOSCO, obviously being more prominent in relation to sustainable finance. We're seeing ASEAN. Obviously, we've mentioned the ASEAN Taxonomy Board. APEC, so I'm involved in APEC, and we have a Sustainable Finance Development Network, which is really trying to join the dots both within the region, but also its efforts as a regional bloc to what's happening in other structures, including the G20 Sustainable Finance Working Group. So we are seeing coordination. And then the other point that I would make is carbon markets. We need and this is just to do with climate, to mobilize that capital, we need to have the right kinds of incentives in the marketplace, the real economy. And for that, we need to have reliable, trustworthy pricing on carbon. And for that, we need functioning carbon markets. So I think the big thing over the next 3 or 4 years is going to be getting carbon markets right. There's been a lot of developments in terms of voluntary markets, offset markets. The standards need to rise there, but they're only transitional. We really need to think about at the national level, for us to meet Paris, what are the carbon budgets that national governments and economies need to adhere to, and then how do we translate that into emissions trading schemes, compliance markets, so real functioning carbon markets working at that level. The final point I will make is we can't, which I touched upon before, we can't just think about green bonds. We can't just think about, we need to extend that. So there's transition bonds. We also need to think about green equity. So we need to look at whole businesses. One, are they green? So are they producing products that help with the transition of economies? So batteries, electric cars, etc. Or indeed, are they traditional companies, but they have a business plan in place where they are transitioning? So it could be a mining company, but it has a business, or an energy company, which is moving from fossil fuels to photovoltaics. Because of the scale, I mentioned 100 to 150 trillion over the next 20 years. We can't just think about kind of structured finance and use of proceeds structures. We also need to reorientate the whole financial system. So I mentioned green equity. We also need to think about green derivatives, because we need all kind of the hedging instruments. We need price discovering tools, etc. And then, of course, around the corner, I've just talked about climate. There's broader sustainability issues, there's biodiversity, and then social. I haven't even touched on social.
There we go. We were just for reference. We have a panel later on focusing on all the other areas outside climate. So hopefully we'll be discussing that in quite some detail later, which is good. Mary, just very quickly, I just want to think about kind of investors and just really how they're evaluating net zero, decarbonization plans of listed companies, that type of thing.
First off, I think Matthew had laid out all the issues and all the immediate next steps very well, and I think cover most of the ground. But anyway, as to the question about investors evaluating net zero plans, I think they are doing it. There's some difficulty, right? It's still an evolving space. But I think for long-term investors, they are looking beyond risk management and looking ahead to identify those companies that are making the most credible long-term commitments and adapting to this dynamic. But there are huge challenges, because when we look at net zero plans, there are quite a bit of diversity and quite a bit of ambiguity. Are we talking about carbon? Are we talking about methane or other greenhouse gases, right? So assessing the credibility of some of these targets and strategies is not actually that straightforward. Actually, nothing about ESG or sustainability is straightforward. But right now, there's a focus on intention and measurement. So I think what investors are urging their investee companies to do is to up their disclosures, particularly on their decarbonization plans, and assessing a company's ability and willingness to measure carbon needs and emissions intensity. And I think some of the emerging best practices that we're seeing are, credible targets and ambitious targets that are not back and loaded, right? Because these plans are sometimes 10, 20, or 30 years out. If the goals are too far out, then the concern is that you're kicking the can down the line. So having interim milestones are important. And investors are also looking at how dependent the plan is on new technologies. Now, don't get me wrong, innovation is great. Without innovation, we're not going to get there. But if 99% of the plan is predicated on some unproven technology or something that's not yet commercially viable, then I think there will be a discount to it. We talk about the carbon market, absolutely important. I think also investors are scrutinizing as to whether companies are relying too much on carbon, on offsets. So some companies that have high emissions may be buying carbon credits to keep net emissions down, but it doesn't actually reduce the overall emissions. So I think there needs to be a balance. And one thing that I can't stress enough is transparency. So companies have a short period of time to come up with credible plans. They may have to go through a few iterations, but very soon, I think investors will hold them to account and start looking for tangible outcomes.
Thank you, Mary. We have a few more minutes left. So Jason, I just want to very briefly touch on this topic around the data providers, ESG data providers. We're going to be talking about this on pretty much a whole session later on. But in terms of what ASCO came out with a few days ago around the guidelines, do you think that'll kind of filter through to APAC, and we'll see kind of a regulation across the region in this space?
Yeah. So, Nick, very quickly on that, I think it's a very nascent industry, right? And you look at across the spectrum, there's actually not really any particular piece of legislation or regulation that really covers the products which these guys produce right now. Say maybe in the financial benchmark space, where you label something carbon, then you have to adhere to it. So that's where just set the base case. Secondly, it's a very nascent industry and it's still developing. I think it can go one of two ways. One, to have some voluntary code of conduct or practices, which the providers can adopt or adhere to. I think maybe it'll start off that way. The second piece is, of course, the regulation, where the regulators themselves try and deal with it, similar to how they would do with rating agencies or fiduciary advisors, right? So I think it can go one of two ways, or it can go on a step by step, or in some markets, they might have voluntary, some other markets, it will go into regulation. A lot of it, I think, will depend. I think the regulators will let it run for a bit, see how things develop, and then before deciding. I think if and this is where I talk about collaboration again, if the data providers themselves can come up with some code to adhere to, I think that would facilitate confidence in the market, and that might preempt some regulation. So that's me crystal ball gazing into the future.
Thank you, Jason. Very interesting. So I'm pretty much done for this session. We've covered a lot, and obviously we're going to be talking a lot about some of these topics over the course of the rest of today. Just before I close out, perhaps give my panelists 30 seconds each. Final parting thoughts. Matthew, would you like to go first?
Yeah, sure. I mean, for me, I think it's really the 3 C's, but the 3 C's stand for the same thing: coordination, coordination, coordination. So we need to see coordination at the international and regional level to make sure that we minimize fragmentation. We also need to see coordination in terms of all those building blocks that I mentioned. And then finally, we need to see coordination between the official sector and the private sector, so that any kind of steps forward actually make sense, and that we can meet this challenge as urgently as possible.
Mary?
I echo what Matthew is saying. I also believe that, as I mentioned before, I think policy government has a huge role to play, as does the industry. So I think the best solutions will come from all parties working together to find a solution that best fits all of our objectives.
Thank you. And Jason?
Yeah, so it's maybe a pitch for your later session, Nick, but don't forget the S and G as you talk about ESG. Climate seems to drown everything. Climate change seems to drown everything, including even some aspects of environment like biodiversity and so on. But I think it's very important to look at it in a context. And some folks will actually realize that over a period of time, all these things are linked together. So it's very hard to actually handle some of these concepts in environment, climate change without looking at the S and G. So yeah, that's my pitch.
Thank you. A great point to end on. Thank you. So that's it for now. Thank you to my panelists for joining me today. Mary, Matthew, Jason, thank you very much. Please stick around for our next session, where we have an exclusive fireside chat hosted by fellow co-founder Brad McLean with the Deputy Governor of the Philippines Central Bank, Chuchi Fanacia. Thank you.